Hey everyone, and welcome back to the channel! Today, we're diving deep into the US stock market forecast for February 2026. We're standing at a fascinating crossroads for US equities, where several major forces are colliding, and understanding them is key to navigating the weeks ahead. So, grab your coffee, and let's break down what you need to know to stay ahead of the curve. First, let's set the stage with the macro backdrop. All eyes are on the Federal Reserve. After a period of careful observation, the Fed has signaled a shift in its monetary policy. We're now anticipating the first in a series of potential interest rate cuts. The big question isn't asterisk. If asterisk, they'll cut, but by how much and how quickly. The market is currently pricing in a 25 basis point cut this quarter. But any deviation from that expectation could send ripples through the market. Simultaneously, we're looking at GDP growth figures. Recent data suggests a slowdown from the more robust growth we saw last year. We're in a delicate balance. If the economy cools too much, recession fears could spook investors. If it stays too hot, the Fed might delay further cuts. This tightrope walk is the central drama for February. We need that Goldilocks scenario and economy that's not too hot, not too cold for the market to really thrive. Keep a close watch on the upcoming jobs report and inflation data, as they will be the primary drivers of the Fed's next move. Now, let's talk about market sentiment, because emotions are running high. January was a roller coaster, to say the least. We saw significant volatility, with sharp swings driven by geopolitical headlines and shifting rate expectations. One of the biggest shadows looming over the market is the renewed threat of tariffs. Discussions around new trade barriers are creating a layer of uncertainty, particularly for multinational corporations and sectors reliant on global supply chains. This wall of worry is something the market will have to climb. Investor sentiment is cautious, but not outright bearish. The CBO Volatility Index, or VIX, has been elevated, signaling that traders are bracing for more bumps in the road. Despite the macro headwinds, the story from corporate America is surprisingly resilient. Let's dig into corporate fundamentals. The earnings season for the fourth quarter of 2025 painted a picture of solid, albeit moderating, growth. Overall, S&P 500 earnings are projected to grow by about 8 to 10% year over year. This is a healthy number, and it provides a fundamental floor for market valuations. The undeniable superstar here is the technology sector, fueled by the relentless march of artificial intelligence. Companies at the forefront of AI, from semiconductor giants to software as a service, platforms are posting incredible results. They aren't just meeting expectations, they're blowing them out of the water. This AI-driven productivity boom is contributing a disproportionate amount of the S&P 500's total earnings growth. The narrative is clear. Companies that are successfully integrating AI into their operations are winning, and investors are rewarding them handsomely. Let's zoom in further with a sector-by-sector analysis. As we just discussed, the technology and AI sector remains the market leader. Beyond the mega-cap names, look for second-tier players in cloud computing, cybersecurity, and data analytics that are also riding this massive wave. Valuations are stretched in some areas, so stock selection is crucial. It's not about buying any tech stock. It's about finding quality companies with a clear path to profitability. Next up, the energy sector. This is a classic value play right now. After a period of underperformance, oil and gas stocks are looking attractive. Geopolitical tensions and a disciplined approach to production from major oil-producing nations are keeping a floor under energy prices. With strong free cash flow and attractive dividend yields, this sector offers a compelling hedge against inflation and a good source of income for patient investors. Finally, let's look at the consumer and financial sectors. The consumer is a mixed bag. Discretionary spending is showing signs of weakness as savings dwindle and credit card debt rises. However, consumer staples to companies that sell everyday necessities are holding up well. In the financial sector, banks are in a tricky spot. Lower interest rates could squeeze their net interest margins, but a stronger economy would reduce loan defaults and boost investment banking activity. Regional banks, in particular, will be under the microscope. So, how could this all play out? Let's consider a few scenarios. First, the bullish scenario. In this outcome, the Fed executes a perfect soft landing. They begin cutting rates. Inflation continues to fall gracefully, and GDP growth stay. The tariff threats fade into the background, and AI-driven earnings growth continues to surprise to the upside. In this case, the S&P 500 could break through previous highs and target new territory. Market breadth would improve, with cyclical sectors joining the tech rally. Next, the moderate or base case scenario. This is the most likely path. The Fed cuts rates, but economic data is mixed, leading to some GDP growth slows but avoids a recession. Tariff talks create ongoing headline risk but don't escalate into a full-blown trade war. In this environment, the market likely grinds higher, but with more volatility. We'd see a rotation between growth and value as investors react to shifting economic data. Expect a range-bound market with opportunities for skilled stock pickers. Finally, the bearish scenario. Here, inflation proves stickier than expected, forcing the Fed to hold rates higher for longer, or even pause its cutting cycle. The economic slowdown accelerates, tipping the U.S. into a mild recession. At the same time, the tariff threats materialize into real policy, disrupting supply chains and corporate profits. In this scenario, we could see a significant market correction with the S&P 500 retesting its lows from last year. Defensive sectors like healthcare and utilities would likely outperform. So, what are the strategic takeaways for you, the investor? First, diversification is your best friend. In a market this uncertain, you don't want to be over-concentrated in a single sector. A balanced portfolio with exposure to AI-driven growth, energy sector value, and defensive staples can help you weather the volatility. Second, focus on quality. Regardless of the sector, invest in companies with strong balance sheets, consistent cash flow, and a durable, competitive advantage. These are the businesses that can thrive in any economic environment. And third, stay informed, but don't panic. There will be a lot of noise in February. Don't let day-to-day headlines force you into emotional decisions. Stick to your long-term investment plan and use periods of market weakness as opportunities to buy quality companies at a discount. This is a pivotal moment for the market, and the events of the next few weeks could set the tone for the rest of the year. It's an exciting time to be an investor, full of both challenges and incredible opportunities. Thanks so much for watching. I hope this breakdown helps you navigate the market with more confidence. If you found this video helpful, please hit that like button and subscribe for more in-depth analysis. Let me know your thoughts on the market in the comments below. See you in the next video.